A startup named Eisen has secured $10 million in Series A funding to help crypto and fintech companies manage a growing regulatory challenge: the transfer of dormant accounts to state treasuries. This process, known as escheatment, is increasingly relevant in the crypto industry as users lose access to their accounts or simply forget about them. Once these accounts are deemed inactive for a certain period, typically defined by state law, the platforms holding the assets are legally required to turn them over to the state government. Eisen's funding brings its total capital to $18.5 million and signals a growing awareness of the risks and costs associated with this process. Escheatment laws were originally designed for traditional financial institutions like banks and insurance companies. These laws require that unclaimed property, such as forgotten bank accounts or undelivered insurance payments, be transferred to state treasuries after a period of inactivity. The rationale is to ensure that assets are not indefinitely held by institutions without the owner's knowledge. But as crypto adoption has grown, so too has the application of these laws to digital assets. Now, crypto exchanges, fintech apps, and securities platforms are also subject to the same rules. The stakes are significant. According to Eisen's CEO, Alan Osgood, a former Coinbase executive, the 2021 crypto bull market created a surge in new investor accounts. Many of these accounts are now dormant. Osgood estimates that around $700 million in cryptocurrency will be. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. Escheated in 2026 alone. Once transferred to state treasuries, these assets are often liquidated immediately, meaning the original owners lose not only the assets, but also any future gains those assets might have produced. Eisen's role is to help platforms navigate the complex and inconsistent regulatory landscape surrounding escheatment. Each state has its own rules for what constitutes dormancy, how long an account must be inactive before being turned over, and what documentation is required to identify the rightful owner. For example, some states require proof of ownership after 2 years of inactivity, while others may require it after 5. Navigating these differences is a logistical challenge for companies operating across multiple states. The financial implications for platforms are clear. If a platform fails to comply with escheatment laws, it could face legal penalties or reputational damage. Worse, once assets are transferred to the state, recovering them becomes extremely difficult. Osgood notes that governments rarely return escheated assets to their original owners, even if they are later identified. This creates a significant risk for both platforms and investors who may not be aware of the rules until it's too late. For investors, the risk is twofold. First, if they lose access to their account, whether through lost private keys, forgotten login credentials, or account deactivation, the funds could be transferred to the state. Second, even if they remember their account exists, the platform may have already turned it over, and recovery is unlikely. This is particularly concerning for investors who may not be actively monitoring their accounts, but still expect to retain control of their assets. Eisen's solution involves helping platforms identify dormant accounts, reach out to users, and comply with state-specific requirements to avoid unnecessary transfers. By doing so, the company aims to reduce the financial and legal risks for crypto firms while also helping investors retain control of their assets. The startup's growing funding round suggests that this is a problem many in the industry are now actively trying to solve. The broader market signal is that regulatory risk in crypto is evolving in unexpected ways. While much of the industry has focused on compliance with anti-money laundering, most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. And know your customer rules. Escheatment is a newer and less discussed challenge. As more states apply these laws to crypto, platforms will need to invest in compliance infrastructure to avoid costly mistakes. Investors, meanwhile, should be aware that simply forgetting about a crypto account can lead to permanent loss of assets. The next signal to watch is how state governments handle escheated crypto. If states begin to hold onto these assets rather than liquidating them, it could create a new market for asset recovery. Alternatively, if more platforms adopt Eisen's approach and proactively reach out to users, the number of escheated accounts could decline. Either way, the growing awareness of crypto escheatment suggests that the industry is preparing for a more complex regulatory environment.